Good morning, everybody. Welcome to day 69 of what turns out to be an irrational and unconstitutional lockdown, at least according to the High Court. We have a full house today. Thank you for all the questions. I'll do my best to answer them as we go through the presentation, slide by slide. It's been a crazy year. Lockdowns, oil wars, trade wars, race wars. Talk about living in a volatile world. Quite unbelievable. Sometimes reality seems stranger than fiction. But I do want to assure you that your savings with the Sygnia funds are performing very well, and first two slides will just talk to that performance. This slide is from the Alexander Forbes Multi-Manager Survey. It shows the 4 flagship Sygnia funds: low equity, low medium equity, and high equity, across various timeframes: 1 year, 3 year, 5 years, 7 years, and 10 years. And as you can see, the funds are doing phenomenally well, number one across almost every time horizon and every category. So the funds are performing as we expected in this volatile and uncertain environment. Similarly, if you look across the single managers, so not just multi-managers, but compared to the single managers, the funds are also doing very well across the time horizons. Second over 1 year, first over 3 years, third over 5 years, and first over 10 years. Managing the risk in the portfolios through asset allocation to match the economic environment is key to consistent performance. I'm going to take you through our views of the markets and economics, and then towards the end of the presentation, I'll explain how those markets and economics are impacting our positioning and what we're doing with our portfolios. So let's jump into ecos and markets. The markets continue dominated by the COVID-19 global pandemic and the associated recession. The World Health Organization characterized the COVID-19 virus as a pandemic on the 11th of March, and many countries across the world went into a state of emergency and full lockdown. As a result, 2020 growth will see the deepest GDP falls since World War II. The chart on the right there shows the expected GDP fall from the COVID-19 recession compared to previous recessions over the last century. And you can see there only World War II and the Great Depression of the 1930s impacting GDP more severely. Fortunately, May is over. We're now 4 weeks into the beginning of exiting lockdown, of returning to the new normal, whatever that normal may be. When looking at the Google Mobility Index or the Oxford Stringency Index, both are showing signs of improvement, that the world is getting back to normal. People are leaving their homes, people are starting to work. But just as there was light at the end of the tunnel from the lockdowns, Trump started to wave his flag. Trump continues to focus on his elections and is determined to find a common enemy to rally his voters behind him. The markets are now concerned about rising US-Sino tensions as the US Senate passed a bill barring Chinese companies from listing on American exchanges, as Trump continues to blame China for COVID-19. Sentiment further deteriorated towards the end of the month as Beijing imposed national security legislation on Hong Kong. Trump was the first to point fingers and to threaten a range of sanctions, despite what's happening in his own home backyard, with riots spreading across the country rapidly. So it's interesting to look at how Trump's doing in the polls. If you look at betting odds, Trump is still in the lead with a 55% chance of winning the election in November, compared to Biden with a 45% chance. But we must expect continued volatility throughout this year as we move closer and closer to the elections, and as Trump tries to pull any trick out of the bag to ensure that he is victorious when it comes to November. So how are the markets doing? Markets have been decimated this year with the recession, but they do continue to recover, and more importantly, they do continue to differentiate between the lockdown losers and the lockdown winners. So have markets overshot? Are they fair? Are they undervalued? What is the valuation? So if we assume that April was the trough of economic activity, So the trough of the recession happened in April. Now that we're into May and June, the world's GDP growth starts to recover. Chinese PMIs are already at 55 for May. So assuming that we're now 1 month into the recovery, we can look at previous recessions and take an average. So if you look at the last 4 recessions and take an average 1 month into the recovery after the trough, markets are normally about 60 to 65% up from their lows. Our markets are roughly on a whole in general at that level, around 60 to 65% from their lows. So markets, while they seem to have bounced very quickly, and it has been a very quick bounce, as quick as it was a fall, they're roughly fair compared to previous recessions. However, there's still a big disconnect between lockdown winners and lockdown losers. So on the loser side, you've got emerging markets, you've got banks, property stocks, emerging market currencies. On the winning side, you've got the dollar, you've got healthcare stocks, you've got tech stocks, gaming stocks in particular. This chart shows the impact of the various sectors and asset classes. The blue line shows the year-to-date performance. So looking at the top there, property is still down 40% year-to-date, and it's had a very muted recovery over the last 2 months. It's only bounced about 6%, and it remains one of the lockdown losers. The bottom of the chart, you can see similar story with EM currencies, with the rand there having depreciated about 30% year-to-date, with only a very small recovery towards the end of May, recovering about 1%. Similarly, with global bonds, hardly any bounce. So the market's very much saying that EM currencies are still lockdown losers. SA property is still a lockdown loser. The one asset class that has had a decent bounce is oil. So you can see the oil second from the top, only down 17% year-to-date, with a 44% bounce from beginning of April. That's not as much a result of a move between lockdown winners and lockdown losers as it is a reduction in the supply, with OPEC Plus cutting 10 million barrels a day out of supply. Then in between there, you can see the equity markets, which are still down year-to-date. We've got emerging markets down 14%, the SWIX down 10%, MSCI World in dollars down 5%, even S&P in dollars down 2%. There has been a recovery, as the gray lines show, but that recovery has been driven primarily by the defensives. So the tech stocks, the healthcare stocks. The US has done pretty well because it's got a high proportion of tech and healthcare, and the dollar has been a winner, seeing as it's a safe haven asset. But it's very, very comforting to see the differentiation that markets are making between lockdown winners and losers. It means that markets are functioning correctly, that the liquidity exists and people are able to trade. But the panic that happened towards the end of March hasn't reoccurred, that markets are functioning, that liquidity is there, and people are able to trade where they need to. So overall, a comforting story that markets are at least functioning and differentiating between the lockdown winners and the lockdown losers. As a whole, markets have recovered in line with previous recessions, not looking expensive or cheap compared to past recessions. Central banks have once again done a phenomenal job. The chart on the left shows quantitative easing on a monthly basis. And you can see there nearly $1.4 trillion of bonds were bought by central banks in April. The number completely dwarfs what happened in 2008, 2009, when we had the global financial crisis. So liquidity really is abundant. Central banks are doing a phenomenal job pumping tons and tons of liquidity into the market, buying bonds at an accelerated rate. And that's kept markets functioning. The dollar is significantly off its highs, and liquidity is ensuring that markets are functioning. Yes, not on its own a necessary or a sufficient step to drive markets to new highs, but certainly required. Without this liquidity, markets would still be frozen as they were in March. So we're very happy to see the huge amounts of liquidity that are happening. They're already beginning to taper off in terms of the peak, but still a lot of bonds being bought each month by central banks, which is keeping markets efficient and functioning. The fiscal response has also reached new highs and has been very supportive of markets. The table on the right shows the extent to which fiscal support is happening this year. In the US, we have 15% of GDP. In Japan, 22% of GDP. In Germany, 4% of GDP. Italy, 4%. UK, 8%. And Canada, 12%. Huge amounts of fiscal support going into the markets. Quite phenomenal. But fiscal support or taking on debt does lead to problems down the line. You can see the chart on the left that the levels of debt to GDP in the world now are approaching 70-year highs, back to the highs of World War II. Huge amounts of debt are being taken on by governments. And yes, this is necessary to prevent job losses, to prevent companies becoming insolvent. But debt does steal growth from the future. And taking on all this debt now, while it props up growth now, does mean that future growth is going to be lower. Why is it lower? Well, it means that people will save more for the future. Apologies for that. I just reshared the screen. So why is high debt a concern? High debt is a concern because people spend less now and save more because for a number of reasons. The primary one is that they expect to have to pay back the debt in the future through higher taxes. There's also increased volatility due to high levels of debt, so people want to save more in case there's another bump, another recession. At the same time, governments have to pay more on interest, so they can spend less on investing in projects that drive growth. And lower interest rates mean that more zombie companies can survive, which grow slower than new creative companies. And investors have to save more for retirement because with lower yields on interest rates, it means you have to have a much larger pension when you get to retirement to have the same level of income. So generally, while debt is needed now to get us through the gap, it does take that spending from the future and brings it forward, and means that growth over the next decade at least is going to be much lower than it was in the past. So you might think, well, not a problem. Look at World War II, post-World War II, the debt levels were at the same levels, and we managed to grow ourselves out of that debt very nicely. Yes, it took 30 years, but we did reduce that debt significantly. There were a lot of tailwinds that helped the world grow out of that debt that don't exist anymore. So growth is a function of two factors. One is labor force, so how many people are working, and the second is productivity, how efficiently those people are working. So we had huge increases in the labor force post-World War II. We had baby boomers, which led to growing demographics. We had women entering the labor force. We had emerging markets entering the labor force through globalization. All of those led to more people working than had been working before. We also had increases in productivity. Education levels improved dramatically. We moved into information age with computers, leading to huge increases in productivity. Globalization as well led to increases in productivity. We're seeing all of those productivity increases becoming a lot more marginal as we go forward. Education, for one, has peaked. We haven't seen an increase in education over the last 2 decades. Globalization has peaked over the last decade. So the tailwinds we had over the last 2 decades from increasing labor force and increasing productivity, we're not seeing those, or we're not unlikely to see those over the next decade. So we have huge levels of debt without the tailwinds that we had in the 50s and 60s and 70s, which helped us grow out of that debt. We also are unlikely to inflate out of debt, as recessions generally lead to disinflation, not to inflation. In fact, we saw a stepped down level of inflation after the global financial crisis. we were expecting a couple of years of lower inflation, and then as people saved more and increased their risk appetite, so inflation was expected to return, it never did. So we're seeing step down levels in inflation, we're seeing lower levels of productivity, we're seeing aging demographics reduce the labor force, and all of that means it's going to be much harder for us to grow, full stop, over the next decade, and they're much harder to grow out of debt. So we're stuck in this circular reference of higher debt meaning lower growth meaning it's more difficult to reduce those levels of debt. That has quite a meaningful impact on how you position your portfolio, and I'll go through that when we get to our positioning slides. So what about South Africa? We're now in stage 3, day 3 of stage 3, for at least the next 14 days. We have until June 14th when the current 3-month state of disaster ends. And by then we'll probably have a new set of regulations that will hopefully be more rational than the current ones. And the Constitutional Court or High Court will at least approve them, and we'll see some sort of rationality happen on that stage. But it's quite uncertain as to what those are going to look like. Right now we're in stage 3, and we've got 8 million people returning to the workforce, which is very important. We did see Moody's downgrade South Africa to junk on the 27th of March based on increased levels of debt, weak growth, and a lack of structural reforms. And then South Africa left the WIGBY on the 30th of April. Since then, bond yields have strengthened 3%. So that event having passed has actually been quite beneficial to our currency and to our bond markets as we move past the concern that a lot of people were waiting for. In terms of the response to the COVID-19 recession and the lockdowns, the SARB further cut rates. We've now had 3% of rate cuts over the last year. The repo is 3.75%, lowest it's ever been in history, and it's freeing up at least 80 billion into the economy. So that's very beneficial. In terms of trade, have also improved dramatically. The oil price has recovered slightly from $30 to $40 a barrel, but it's still way off its highs. Whereas gold continues to make new highs, and platinum as well, and rhodium and the 3 PGM basket are moving higher. So as the value of our imports comes down in terms of oil and the value of our exports goes up in terms of precious metals, that helps our trade deficit, which is positive. The government did announce a 500 billion rand fiscal support package, which does take our budget deficit to a record high of 11%. But we face some uncertainty as to exactly how that is going to be implemented. And it's very unlikely it's going to dent our growth in 2020 significantly. And we're still expecting at least a 9% fall in growth this year. So we are desperately awaiting government's 3rd phase, which is speedy implementation of economic reforms to see how we can boost growth in future years. Unfortunately, despite having moved to level 3, it's probably a little bit too late for our economy. After 2 months of lockdown, growth has fallen significantly. A survey from APSA shows that 75% of SMEs may close due to the lockdowns. That's 28% of jobs. And if you include the informal sector, it's almost half our jobs in the country. So it's vital that we do get the SMEs back working. It's vital that we do get the informal sector back to work as quickly as possible. Stage 3 or level 3 is a step in the right direction, but a lot of damage has been done to the economy from the lockdown. So yes, we do await speedy implementation of economic reforms. We do await clarity on the 500 billion rand, how that's going to trickle down into the economy and boost the SMEs that have been impacted. And we await levels, details on those plans. Unfortunately, there hasn't been much clarity there. We did finally yesterday see a draft rescue plan for SAA, but that's been 6 months in the making. Hopefully it won't take as long to get other structural reforms to come through. And even as it stands, it looks like it's going to cost 20 billion rand to start the new SAA. 16 billion rand in paying down existing debt and 4 billion rand cash injection to keep it going. So not as reformed as we were hoping, but at least we have finally seen a draft from the draft rescue plan. There was a question about prescribed assets. Does the huge amount of debt that South Africa is taking on require prescribed assets? And the good news is that's highly unlikely, particularly at a government level. South African bonds remain incredibly attractive. The yields are amongst the highest in the world, 6% in dollar terms when you hedge the currency. It's our preferred asset class. It's many asset managers' preferred asset class. And while there's a huge demand for local bonds, it's unlikely there's going to be any requirement to force investors to buy those bonds. What there may be is a change in Regulation 28 to allow further investment into unlisted equities and unlisted debt. But currently there is a cap on the amount of unlisted assets you can invest in. And that is actually a good thing. More freedom in Regulation 28 will allow a more diversified portfolio. And with the volatility that we're seeing, access to a more diverse range of investments, including private equity and venture capital, impact funds, could be very beneficial to our portfolios. However, it's very important that that is done in a correct manner. So if we look at the first round of wind farm projects that went through a few years ago, there was a lack of consistency in terms of how that was dealt with. There wasn't one central point at which you could access the debt. It was done across various providers, across various levels, and at various prices. So some investors got in early and did incredibly well. Some investors got in late and actually did quite poorly. There wasn't consistency across the levels to the types of products that were available. Some was equity, some was debt, some was a combination of the two. So we do need a much more centralized access point to those sort of investments with much better transparency, much better governance, much better coordination. If we can achieve that, particularly better transparency, then those assets could offer up very exciting opportunities for pension fund portfolios that have the long-term view and where they're not as concerned with short-term liquidity, and they can benefit from the liquidity premium that you earn as a result of investing in those assets. So that could be a good thing. So let's look at investment allocations. How does this all come together? As I said, global liquidity is way in excess of what we need to bring down the cost of money to allow the markets to function correctly. We have QE that is 5 times the level that it was in the Great Financial Crisis. At the same time, fiscal support is far in excess of what we were expecting. We've got multiples of GDP that have been pumped into support markets, taking debt up to global debt up to new highs. So in the short term, lots of support in terms of liquidity and growth. So what's important then is looking at the recession that's been driven by the lockdown and understanding where we are with the lockdown and whether we are going to see a second wave of lockdowns. So we're 4 weeks into the relaxation process. We started to move out of the extreme levels of lockdown at the beginning of May across the world. And fortunately, there's been little sign of a second wave of infection. Yes, it's 4 weeks is possibly too soon to be comfortable that there won't be a second level, and there are likely to be hotspots. But the research that's been done suggests that not only has there not been an increase in infection, but there's been a decrease. So the chart at the top there from JP Morgan shows that countries that have moved out of lockdown are seeing a decrease in infection rates, not an increase, which is very promising. It means that social distancing, wearing of masks, or maybe a misunderstanding of the virus itself, but what we're doing is working sufficiently to avoid a second wave of infections coming through. The chart on the bottom there from UBS shows a very similar story. It shows that there's little correlation between the infection rates and the level of mobility or the level of lockdown that's being enforced on various countries. So the data seems to suggest that even if there are hotspots that arise over the next couple of weeks or next couple of months, or even if there is a slight pickup in infection rates, as there have been slight pickups in South Korea and China and Japan, that those shouldn't lead to further lockdowns. Particularly if now that we're set up to deal with this correctly. So in the developed markets, the way that they are using testing and surveillance and isolation is working very, very effectively. South Africa and other emerging markets, that's not working as effectively because there isn't the same access to the level of testing. But there you do have the benefits of younger populations, and as long as you isolate the high risk, which is in this case people who are obese and old, that is having a successful rate of reducing infection. In fact, I believe in Cape Town, we're no longer testing anybody below the age of 55. If you do show symptoms, it's just a case of isolate for 14 days. If you are high risk, isolate, and only if you show symptoms and above the age of 55 will they even do a test. So that goes to show that testing in emerging markets is not as successful as testing in developed markets, but we do have the benefits of younger populations. And the charts do look at both emerging markets and developed markets. And generally there's a case of the modeling that happened before we understood the virus properly suggested that R0, as it's called, or the reproductive rate of the virus was constant. And we're starting to see that is not the case, that the virus tends to run itself out, or at least it doesn't grow exponentially after the first 2 months. A report out from Panda locally, one of the actuarial groups is suggesting that, and there have been foreign global research documents are suggesting the same thing, that for some reason after 2 months it increases still, but not at an exponential rate. And whether that's because social distancing is working, or whether it's because of herd immunity, or whether it's just because it's a respiratory virus, and generally respiratory viruses don't tend to last more than 2 months. Well, the good news is that we are seeing a decrease in the second wave, the probability of a second wave of infection. And even if that does spike, we definitely are seeing a much lower likelihood of severe lockdowns, because the data is showing so, because there's been a lot of reaction to the lockdowns that have happened. There's a possibility that the race wars we're seeing in the US are linked to civil lockdowns. Certainly, we're seeing all the legal actions that have been taken in South Africa against the lockdowns. People need to weigh not only one side of the equation, but there's always two sides to any equation. You just look at the cost and the benefits of a lockdown. So the bottom line is that we are seeing a reduced likelihood of lockdowns. The other side of the equation is we need to push through until we get a vaccine. So the vaccine's now probably only 6 months away. WHO is coming out to say we're likely to see one with mass production in November or December this year. So 6 months away until a likely vaccine. We've got 160 vaccines that are being researched. 5 already have started human trials. So we've got to push through for the next 6 months. So we've got 6 months to go until a vaccine and things can revert to some sort of new normal. There's less likelihood that there's going to be major second wave infections, and if there are, much less likely that there'll be a lockdown. So what does that all mean to the economy? Well, it means that you are less likely to see an L-shaped recovery and more likely to see a V or a U-shaped recovery. Now, if you look at the markets are certainly pricing in different outlooks compared to different asset classes. So the lockdown winners, healthcare and tech, those are pricing in a very sharp V-case recovery. In fact, they're showing almost no impact to their earnings, and most of those asset classes, so the dollar, gaming stocks like Naspers, tech stocks, healthcare stocks are at new highs. If you look at the lockdown losers, like emerging market currencies, emerging market banks, like our banks, South African property stocks, South African Inc. in general. In fact, South African incorporated stocks are 55% down compared to South Africa SWIX global stocks. So you look at our listed stock market, and you split that into two, which stocks like banks and property and retailers are locally focused and which are globally focused. 55% underperformance over the last 12 months, 40% of the year to date. So you can see that huge differentiation in performance. Those asset classes are certainly saying an L-shaped recovery. In fact, they're saying that the lockdowns are never going to end, and if they do end, so much damage will have been done to those counters that they'll have to do rights issues at the current prices, which will permanently damage their earnings, and they won't be able to recover. I think that's unlikely. I think given the fact we are 6 months away from vaccine, and given we are more likely to see a U-shaped recovery in emerging markets, not as fast as developed markets, but still a U-shaped recovery, that there is some value to those asset classes. And we have seen over the last week, markets start to rotate out of winners and in lockdown winners and into lockdown losers. So as growth recovers in terms of looking at PMIs, forward-looking growth indicators, PMIs are ticking above 50 in China. Oil's now about $40 a barrel. We are seeing growth in terms of mobility improving, and as a result, the markets are now saying maybe it's time to move out of the winners and into the losers. Now, I think this is going to be with us for some time, at least for the next 6 months until a vaccine happens. We are likely to see some rotation. It's not going to be complete rotation. It's certainly the lockdown losers are definitely not going to recover to their previous highs. They do face headwinds. There has been some permanent demand destruction, but there's likely to be a wave of winners recovering losers recovering relative to winners. Then, as we see hotspots resurface across the globe, that might taper a bit. I don't think we'll see the lows we have in terms of winners versus losers, but that might rotate a bit. And then when those hotspots become under control, the rotation should happen the other way. So I'm expecting a lot of volatility to result as a result of the waves of hotspots that are likely to emerge, and the performance of lockdown winners and lockdown losers is going to differentiate as a result. So we are expecting the losers to recover a bit. We are expecting the rand to recover slightly from these levels. The rand has already done very well over the last week, coming in from above 18 to the dollar to close to 17 to the dollar. South African bonds have continued to rally. SA Inc. stocks have only just started over the last few days to recover, but we are seeing the rotation start to take place. So what does that mean in terms of positioning? Well, I mentioned last month about Japanification. Japan has been fighting deflation for 30 years. And this is important in terms of a roadmap to how we get out of these huge levels of debt that we're seeing around the world. And again, unfortunately, we have to differentiate between developed markets and emerging markets, but looking first at developed markets and using Japan as the roadmap. So Japan has been fighting deflation for 30 years. They had a bubble burst. They went into a recession, the early 1990s. Since then, they've taken on huge amounts of debt. Their debt to GDP has reached 230%, higher than any other country in the world, more than double even the highest countries around the world. At the same time, they started quantitative easing in 1997. So they're now 23 years into quantitative easing. They have bought, or they own 50% of the bonds that they've issued. So despite their debt being ridiculously high, 230% of GDP, they own half of that debt. So they've managed to keep yields low by buying that debt and using quantitative easing to keep the interest rates low so they can afford to keep issuing debt and buying the debt. So there's certainly a blurring between fiscal policy and monetary policy that's happened in Japan, but it has allowed them to keep support, to allow them to keep interest rates low, and to allow them to keep building bridges, building railways, building whatever it needs to be built to create jobs. But despite that, if you look at the chart on the right, their equities are still half the level they were in 1989. So their equities peaked in 1989. So 30 years later, their equities in nominal terms are half what they were. There have been some phenomenal recoveries. They've bounced more than 100% at times, but they're down half. The chart on the right just shows the last decade, and you can see there that's the relative PE of Japan compared to MSCI World. And you can see how that PE relative has fallen as growth in Japan continues to fall due to the high levels of debt. At the same time, the interest rates have also continued to fall, and the other line on that chart shows their level of interest rates. So despite huge amounts of fiscal support, despite huge amounts of monetary support, all that's happened is growth has continued to slow, the interest rates have continued to fall, and inflation has continued to not exist. And they continue to face disinflation. So this is partly as a result of demographics, and it's partly a result of the recession that they saw in the 1990s, which was reduced confidence, and we are likely to see that happen in other developed markets with aging demographics and high levels of debt. So Europe nearly a decade ago moved into a similar place with high levels of debt and aging demographics. The US now, although it was only supposed to be there in about 5 years' time, the COVID-19 recession has accelerated that process, and their interest rates are close to zero. And we are seeing a lot more backlash against immigration, which is going to reduce their working population growth. So the US is reaching that point now. So it's likely that those developed markets are not going to be able to grow their way out of debt. They're not going to be able to inflate their way out of debt like they did post-World War II. They're going to be stuck in the Japan roadmap where they just have to take on more debt and support the economies through lower interest rates, through QE, which allows them to keep interest rates lower and allows them to issue more debt. Emerging markets are a different story. They don't have the same confidence. I mean, what allows markets, Japan in particular, to have kept its interest rates so low is that they promise at some point in the future to reduce the levels of debt. So at some point in the future, when growth allows, that there will be austerity, they will reduce the amount of debt. Of course, 20 years later, they haven't, but the promise exists. But given that promise, it's enough for investors to believe in. Emerging markets don't have that sort of that same faith. Investors don't believe that they will do that, and rightly so. There have been a lot of defaults. Argentina, in particular, is one that has defaulted numerous times, and so QE is not going to be a tool that's available to emerging markets to allow them to keep interest rates low and allow them to continue issuing more and more debt. So emerging markets are going to have to debase their currencies or inflate their way out of debt or default their way out of debt. So a very different story, but that will keep emerging market growth elevated as well. So a different roadmap for EMs compared to DMs. But Japanification, I mean, DMs do make up 90% of the MSCI all country index or world index. So it's important that we do focus on what's happening in developed markets. And there, the Japanification roadmap is still set. And Sygnia did position our portfolios 2 years ago to roadmap to expect reduced growth, which means that equities are going to give lower returns than they have in the past. It means that you need to diversify more. It means you need access to more credit and more private equity or venture capital and other asset classes. And you also need to be a lot more tactical in terms of harnessing that volatility that's around. And the first two slides I showed at the beginning of the presentation in terms of relative performance in the surveys against multi-managers and single managers shows that roadmap is working, that structural strategic asset allocations is working for the portfolios. From a short-term perspective, what are we doing? From tactical asset allocation. Well, SA equities, we continue to be underweight. There has been a very strong bounce within SA equities as a result of Naspers, which is nearly a third of the SWIX. Naspers has done very, very well and has kept our markets quite strong. Because of the huge weighting in that, our market has recovered quite significantly. Without Naspers, our markets would be actually quite close to their March lows. So again, a very big differentiation within the market that given the strong run, we're comfortable to be underweight SA equities, and we have hedged some of our Naspers in terms of relative weight, and expecting that switch to happen out of Naspers or lockdown winners into lockdown losers. We do remain overweight global, but again with protection. So as the rand continues to strengthen towards 17, we have had many tranches of protection. We are taking those tranches off as we are hitting various profit levels. So we are protecting the portfolio as, despite being overweight offshore assets, we are protecting the portfolio, and that is working quite nicely. And given QE distortions, particularly in Japan and Europe and now the US, we've avoided global bonds. And again, the asset class performance that I showed you on the third slide showed that global bonds haven't provided any additional protection compared to dollar cash. The rand is your biggest shock absorber. The rand is the best uncorrelated asset class when it comes to protecting performance in a risk-off environment. And so it's good to have an overweight allocation in your portfolios to offshore assets to provide that downside protection, but not through global bonds. We don't think that that's providing any additional protection. And when we do see some normalization in terms of risk premia over the next year or two, bonds are going to recover, not anywhere close to where they have been over the last 30 years, bond yields, but they yields will rise, and that will see a detraction in the capital gains in terms of global bonds and developed market bonds. So we avoid global bonds completely, and we do have an allocation to our impact fund, our global ESG impact fund, which is providing some very good uncorrelated performance in terms of the Oxford Sciences Innovation Portfolio, and that, as I'm sure many of you have seen in the press, does one of the 76 children in there is involved in developing a vaccine that is looking quite promising for COVID-19. So that's exciting. A number of the children, in fact, are looking at a variety of different vaccines, but the one is looking very promising. And they've actually already started to stockpile production in case that vaccine passes human trials. So exciting to have something of that caliber in the portfolios. Looking locally, the 300 basis point rate cut has reduced cash to 4.5%. 4.5% is quite a low return, considering the risk that exists in terms of our currency, considering the risk that exists in terms of SA Inc., and to only be earning 4% for taking on South Africa risk doesn't sound like it's a good risk-reward relationship. So as a result, we have reduced our cash as much as possible, and we've also slightly cut our income assets, because income is cash-based. It's going to be cash plus 2%. And we've taken, or keep bonds as an overweight on the local side, as that's still looking quite attractive. The SA yield curve is as steep as it's ever been in its history. It's recovered slightly, but there's still the differentiation between the long end and the short end is 5%. So you're getting an additional 5% return by taking on the additional volatility from the term premium, and we believe that is a risk that is certainly being well rewarded, and so we are quite comfortable in terms of taking on that risk. So underweight cash locally, underweight equities locally, overweight bonds locally, and globally overweight equities, underweight bonds, and overweight alternative assets. And that is the positioning. Okay, let's go to some questions. Okay, there's a question on the oil market and its recovery. The oil market has recovered as a result of supply cuts. There has been 10 million barrels a day that have been taken out, and you know, we are only at $40 a barrel, whereas the average cost for taking oil out of the ground, apologies, is close to $60 a barrel. So we are expecting to see over the medium term further normalization in the oil price, particularly as supply cuts cut in the US shale gas. So over the next 6 to 12 months, we do think that oil is likely to slowly rise from these levels. There's a question on debt and debt with a debt. There is debt forgiveness. Certainly, there has been a question about that from an emerging market perspective. Our president has brought it up a number of times, asking for debt relief for African countries. We may see some debt relief on emerging markets, but certainly unlikely to see any debt relief in developed markets. Developed markets continue to promise that they will pay back that debt. It's very important in terms of markets believing that debt is not going to be written down, and keeping those term premia as low as possible. View on the US equity market, yes, it has recovered very quickly. Again, that's driven by the fact that it's 40% weighted to tech and healthcare, which have been lockdown winners. If you look within the US banks are also close to their lows. So again, some differentiation between the winners and the losers within that economy. It's just the higher weighting to the lockdown winners that has allowed that market to recover so quickly in terms of its strong weight to FANG stocks and tech stocks and healthcare stocks. Yeah, inflation in South Africa certainly is unlikely to be a concern in the medium term. In fact, since the global recession, there's been in 2008, there's been very limited pass-through inflation in South Africa, despite a weak currency at various times. And just like the rest of the world, we're seeing demand destruction, we're seeing confidence destruction, all resulting in a lack of investment and a lack of demand, just keeping inflation quite low. So, I mean, interest rates are incredibly low compared to even relative inflation. So I do think interest rates will pick up within 12 months, but only marginally as interest rates in the rest of the world pick up. And that's definitely a story for next year, towards the end of next year, only past a vaccine. We're definitely not going to see anything before any interest rate increases before the world returns to a new normal. Okay, I think that's it for the questions. Thank you very much for joining today, and we'll see you next month.